Hello and welcome to the show. I'm Puneet Wadhwan. Today we have with us Andrew Holland of Avendus Capital Public Market Alternate Strategies with us. Good morning, Andrew, and welcome.
Morning, Puneet.
Let me start by asking you your expectations from the upcoming budget.
See, because it's a voted account, then obviously, I suppose not expecting any big decisions, any game-changing, kind of deliverables from the budget. So really more of the same, fiscal deficit maybe around that 5.5% is probably what the market's looking for. Obviously, the government to continuous expenditure, maybe a few new items coming in. Prime Minister Modi mentioned about solar, people's houses. So maybe there's some push towards making that happen, but very much towards the same. I mean, keep the PLI going, maybe expand it to a few other sectors. This Make in India for exporting in the future, is working well. The world likes it. And we're seeing more and more kind of foreign direct investment or interested companies coming to India, not just for the growth of India, but for the potential exports going forward as well. So if it's more of the same, that would be great.
So any budget math that can actually make the markets unhappy?
I think if the government expenditure for next year was lower than the market's anticipated, because obviously then you'll be looking at then the private capex to pick up, and take up the lead from there. So that would be the only thing I think would be a little bit more negative in terms of the capex cycle, and obviously for a lot of the industrials and capital goods players. So that could be one factor. The other factor I'd probably look at is divestments, which they haven't really done so much of. Whether that will be thrown into next year, given where markets are as a source of revenue. So that could be something that we should see on the positive side from the revenue part of it.
Which other sectors do you think will get the priority and why?
So obviously, it's still early days in the electronic manufacturing sector, but we are seeing companies move into the semiconductor industry now, starting to lay out plans and starting to build semiconductor plants. So I think if they extend that going forward, I think that's very good news. Maybe they'll continue to do something with electric vehicles. Again, that would be good news for the whole sector. So I think, I don't think there's anything extra I think the government needs to do. Maybe expand, I think a lot of analysts are talking about maybe expand the PLI into chemicals. It's an industry which has been suffering of late. But it's really an extension rather than it is, any kind of big bang reforms we're expecting at this point.
So how should one approach the PSU, defense, and the manufacturing sectors in this backdrop?
So, but forget the budget for a second. We talked about this before. Defense spending, renewable energy spending is something that's going to happen globally, not just in India. So that's a long runway we have going forward for this sector. Then of course there's the electronic manufacturing sector, which we mentioned with PLI help. And possibly, other sectors might be involved in that. So, I really think that the PSUs have had a great run, and I'm a little bit wary at the moment, given the kind of high multiples a lot of these companies are having. So, what could be disappointing, and I mentioned it before, would be if the capex slows down from the government, whether it's in railways or whether it's in roads and bridges and so forth. If that was to slow, that would have I think a more negative impact on the capex and industrial companies.
You highlighted rail in terms of capex. So how does one approach the rail-related stocks? They've had a super run in the past few months.
Yeah, they have, and it's obviously a lot of expectations there. So as I said, if there's any kind of slippage or expectation is that the government's slowing down expenditure, because don't forget it has to meet its fiscal deficit as well of 5.5% at least going into FY25. So those are the kind of things which I think the government will have to tread very carefully in terms of its capex expenditure. And of course, if you look at the revenue side, yes, tax collections are good; they're continuing to increase, but it's not growing as quickly as it was over the last few years. So again, I think it's a fine fine balancing act I think the finance minister has in terms of that expenditure versus revenue. And I think initially the expenditure, might be brought down a little bit to help with the fiscal deficit.
What is a bigger worry for the markets? Global cues in terms of developments, let's say at Red Sea, US-China conflict, and what it means for the oil prices, or general elections and market valuations back home?
So here's the thing. Let's take some global factors. Because you mentioned the Red Sea and the problems there in terms of oil tankers and goods being shipped there. If that leads to the fact that inflation is a little bit more stickier again going forward, particularly for Europe, maybe less so in the US, maybe that defers interest rates in terms of the reductions that we were hoping for. And of course, for the RBI, we'd probably wait to see what the rest of the world is doing before jumping first. So if that's delayed from, say, March to June, it just means that the cost of funds in India remain high. And of course, that puts pressure on the banks in terms of their NIM. So that would be something which I would see as a more global negative for India. And of course, if China, continues to kind of I know it's doing some stimulus at the moment, but it's still not shored up the property market. Until that happens, I think emerging market investors will stick away from China, which is not good for flows overall into emerging markets. And that's what we've been seeing up until the last few days, when China garnered quite a large amount of foreign foreign flows into China funds. So, and that takes it away from India. So I think emerging markets will fund investors will be looking at China more as the cues for emerging markets, even with the interest rate cycle, looking as though it's going to head south from here.
So from here on till the elections, what's your broad call on the markets? Would you be a buyer on dips, or would you be a seller on a rally?
I think if we can consolidate around these levels, and it's probably a wide range of 21,000 to 22,000. I think that wouldn't be a bad outcome given where valuations are at the moment, and some of the PE ratios in some of the PSU sectors as well. So I think if we consolidate around here, and then after the general elections, the capex cycle, which is seen already by the government, will have that multiplier effect on the economy, which again will help earnings going into the second half of the year. And then private capex should start to pick up because of the continuity of policy, and capacity utilization is rising quite to levels which you need to start building new plants. So I think that's all of what I think will help India. Now, the other factor, Praneet, is whilst interest rates might stay higher for longer here, don't forget we've got $30 billion of bonds investments to come from foreign investors, given the inclusion in the index. That could lower yields, in India, because I'm sure there'll be some front running is the wrong word, but I'm sure they'll be buying ahead of that expectation of foreign investors buying into bonds. So that could be an extra fillip for the market and for the banking sector if that were to be the case.
Thank you, Andrew, for your time today. We hope to see you soon.
Thank you, Praneet.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.